Hi, good evening, everybody. Welcome to this webinar conducted by Ambit Asset Management, and we will begin our proceedings. With I covering over the earnings season scorecard, followed up by the performance of the funds, and an interesting topic, which will be taken over by Bhargav on the SMID, and followed by concluding by a brief macro about happening around the economy. Without taking much ado, I would begin the session, with a quick earnings scorecard. So moving ahead, the earnings the earnings season recently concluded. One of the common themes that we saw across, large, mid, and small cap names is moderation of earnings growth. One common reason has been that the revenue growth for most companies have been, receding over the last 3-4 quarters. Also, this quarter coincided with margin expansion that was, seeing in Q1 and Q2 moderating, primarily because the base effect is now already in the denominator. So when you observe, the portfolio profit and EBITDA growth continues to remain strong despite moderation seen in this particular, across various sort of indexes. So Nifty, for example, delivered only 10% EBITDA growth versus the portfolio delivering 15% growth. Similarly, the PAT growth for our portfolio in the coffee can was in excess of 22%, and 17% PAT growth was delivered by the Nifty companies. Notably and rightfully, as I pointed out, you can see the growth in revenue, sort of moderating from 18%, like, a couple of quarters ago, to now 6%, on a revenue front, whereas our portfolio delivered a double-digit growth in the revenue in the coffee can as well. The similar story pans out even in mid cap. Our, earnings growth has been in the range of 30% versus the index of 14%. Similarly, EBITDA growth is 24% versus 13% for the index and mid cap I'm referring to. And, similar, the story is also on the revenue front. Importantly, even in a small cap space, our PAT growth is ahead of the index, despite a couple of names that did not deliver as per expectations. And in the multi-cap 10x fund also, you can see, we have delivered a 16-17% PAT growth and a 15% EBITDA growth in this particular quarter. So broadly, to sum it up, across our portfolios, we have managed to deliver higher growth compared to index, albeit at a lower, sort of range compared to the previous quarter. But I believe moving ahead, the margin expansion story is broadly behind. Moving to sort of, individual sort of portfolios, I would like to quickly just sum it up on, each portfolio by taking a minute or so. In coffee can, the star performers for our fund in this particular month was, the recently added Zomato. Obviously, they delivered a very strong results, and the part to profitability is been bridging, and we have seen a very, very strong performance by even the quick commerce Blinkit as well. Havells also, showcased, a strong performance in this particular month from a return perspective. From a earnings perspective, they delivered an inline expectation with the market, and Concor has been a good performer for us in the recent. So 2 out of 3, recent edition has done well for us in the month of February. The recent sort of laggards has been, Kotak, Bharti, and HDFC Bank, not losing much, but obviously all three in negative zone. All obviously, which has led to some, laggard in the portfolio. But having said that, recently we have seen an uptick in the portfolio performance, and the recent additions that we have seen will continue to sort of deliver moving ahead as we progressively move ahead. Moving to next, in the good and clean, obviously, Trent remains a star performer even now. Obviously, it's been a year now since we added this particular stock, but Q3, they hit the ball out of the park from a performance perspective. They delivered a industry leading. So they actually delivered almost a 2x growth compared to the nearest competitor in the industry. Blue Star again, gaining, delivering a good results. And similarly, BI delivered a very strong results, which obviously had an impact on the recent price performance of the stock. So all three were winners for the month of February. The laggards has been AU, Chola, as well as Balkrishna. In all the three, Chola has been obviously more of a victim of the recent regulations on the NBFC piece. Nothing wrong with the results or the performance of the company. AU Small Finance again, shared their strategy, which is a little different from what they were completely focusing on, which had impact on the performance of the stock. And Balkrishna obviously had downgraded their volume expectation for a quarter or so, which is obviously had some bearing on the recent price performance. None of them obviously had meaningful issues with respect to incremental going forward. So that's on the good and clean performance. On the emerging giants, the recent the biggest star of the portfolio has been the recent introduction in the portfolio being Venus Pipe is almost up a quarter 25% in a particular month itself. And since that introduction, I think so the stock is up 35%. Suprajit also delivered a good results, which led to a double-digit almost performance in the stock. And Garware Technical Fibers is marginally up in this particular quarter. Now, notably, all these three companies have delivered a good earnings quarter again in Q3. The laggards for us in this particular portfolio has been Sundaram, GMM, and Home First. Home First, the only exception being, Home First, despite delivering a very strong results, have seen a moderation, and I believe they have also been a victim of NBFC regulations or the changes that RBI is consistently bringing forward. We will talk about that when I cover macro and what's happening in the economy later. But both of these portfolio had the exposure, and when obviously the situation is tough, most of the companies tend to sort of impacted because of these. GMM and Sundaram both obviously had a relatively softer quarter, which obviously impacted this particular performance in this particular month gone by. Moving ahead to 10x, so Trent and Venus continues to be a star performer in the portfolio, and Venus, as we also recently added, similar to the timing of emerging giants as well, had done well for us. Aster has also seen a sharp rebound, particularly with post the reasonable results, I would say, not exceptional, but reasonable results that they delivered. CCL products, LTI and Syngene have been a key laggard for us. LTI primarily has been a surprise factor from a guidance point of view. They changed from a industry-leading guidance to a moderate or a slowdown and moving forward, which has always been a surprise for the industry as well as street. Syngene, there is no concerns on terms of earnings growth, but obviously they continue to sort of deliver a very, very robust growth in the CRO and CRMS piece, and which is a very rare sort of feat even in this particular environment. And CCL products, obviously post their strong buildup of capacities, they are in the phase of ramping up capacities going forward. We believe situation will be very different for these names as we progressively move ahead. So with that, I will hand over and invite Bhargav to talk about the newsletter that we wrote on, and I'll hand over to my friend Bhargav. Bhargav, over to you.
Yeah, thanks, Tilok. So this time around in the monthly newsletter, we sort of continued with our theme on looking at small and mid cap outperformances. So if you remember in January, we did write on highlighting key reasons for the re-rating of the sector. Why we believe that one should not sort of write off small cap just basis valuations. So this time around, we deep dived on the IT sector, wherein we sort of looked at the performance of the tier 2 IT companies, and clearly comparison between large caps and mid cap IT companies. Clearly, mid caps have outshined large cap IT, and we sort of deep dived into what are the key drivers in terms of outperformances for mid cap IT. So essentially, this particular slide talks about the share price performance. You can clearly see that the likes of Persistent, Coforge, have clearly outperformed the large cap companies in terms of share price performance, like TCS, Infosys, etc., etc. In fact, now the P multiple for the companies, which you can see from the second chart on the right hand side above, is at a premium compared to large cap. And the main reason for that has been the two charts which is on the bottom. So if you look at on the left hand side, clearly since 2017, we've seen outperformance on the revenue growth by the mid cap IT companies. And also, if you can see on the bottom right hand side chart, that the outperformance on the revenue is also being visible on the profitability side. So clearly, there have been fundamental drivers of outperformance and profits, which have led to IT companies doing well and trading at a premium to large cap companies. Now, let's look at what are the key drivers. So if you look at, if you can move on to the next, So if you can, clearly one of the biggest drivers is the fact that if you look at a lot of these mid-cap IT companies, they operate in a sort of niche which has been neglected by many large-cap companies. So just to give you an example, like Mastech, which we own in the portfolio as well, niche for Mastech has been the UK public service and partnership with Oracle. So clearly, this is one of the niche in which Mastech has done pretty well. Likewise, if you look at Tata Tech, they have focused a lot on auto ER&D as a niche, which obviously has been the key driver of their revenue growth. And now that you are seeing a lot of new launches and also sort of EV gaining market share, the role of auto ER&D has been rising phenomenally. Likewise, if you look at sort of Kignity, it has been doing extremely well in their niche, which is software testing services. And also, if you look at KPIT, which again is into auto ER&D, has been sort of doing well. So what we are trying to highlight is that clearly these mid-cap companies around their niche offerings, which they are delivering in terms of both revenue profitability performance. If you look at the second chart on the top on the right hand side, you can clearly see that Wipro too had a niche business, which is the R&D services business, which was about 50% of revenue in 2001. However, if you look at 2007, that business dropped to about 35% of revenue, and that has been consistently sliding. What we are trying to highlight is that clearly, large cap companies focus more on businesses which are scalable, and few of the niche businesses in which these mid cap companies operate are not very large, and hence sort of don't face a lot of competition from large cap IT companies. One of the case studies which we have highlighted is being displayed in the chart on the left hand side. So if you look at the third chart, wherein we compare KPIT and HCL Tech on their ER&D business, what we understand is that HCL Tech did have a good ER&D business to start off with, but unfortunately they did not capitalize on the business just because it was scalable. On the other hand, KPIT, which operates their ER&D business, and you can see the share price outperformance, wherein KPIT has done reasonably well as compared to HCL Tech. Likewise, if you look at the table on the right-hand side on the down, we've given a case study of a Persistent System. So Persistent System has clearly been ranked as a leader in software product engineering. In fact, even with the low-code platform providers, Persistent has received the highest certification amongst all Indian system integrators. So clearly, these businesses on their revenue base are very much scalable, and given that they have sort of designed a niche around these businesses, we continue to sort of like them, unlike in large cap where they are more into scalable businesses and not into niche businesses. The second reason, if you move on to the next slide, what we like about many of these mid-cap IT companies is they have got the right captain to sort of steer the ship. So what we did was that across these mid-cap IT companies, we looked at the top management. In most of these companies, what we find is that the top management had earlier been working in leading roles at tier one companies. And because many of these tier one companies did not focus on scaling up the niche offerings, they sort of moved on to lead as CEOs in mid-cap companies. And since they became CEOs, they started bringing talent from the large cap companies and strengthening the top management teams. So in this table, you can clearly see, if you look at Coforge, the CEO Sudhir Singh has come in 9 years, and before that, Genpact, where he had worked for about years. And likewise, for several other mid-cap IT companies like Birlasoft, LTI, Mindtree, Emphasis, Clerks, Mastech, etc., etc. Mastech, where Hiral has worked with Wipro for about 13 years. The other thing which they did rightly is that as and when they brought talent from large cap companies, they also incentivized them by giving ESOPs. So on the right hand side, you can see Persistence case study where the ESOP expenses as a percentage of revenue has been consistently increasing since FY20, where it was about 0.7%, and in FY23 it increased to about 1.6%. And resultantly, if you look at, there is a clear attrition and incentives. So if you look at a few of the mid-cap IT companies like Persistent, Coforge, they did see a spike in attrition, but obviously that spike in attrition was much lower as compared to companies like TCS and Infosys. So what we're trying to say is that bringing talent from tier one companies, giving them incentives has led to lower attrition and these companies outgrowing large companies. If you look at the two charts which are on the bottom side, what we also see is many of these mid-cap companies trying to be aggressive through the M&A route as well. So what they are doing is that if they don't find capabilities in-house, they are fairly aggressive and open to doing M&As in order to broad base their product offerings. The case study being of Persistent and Mastech, which we have highlighted here, and we've also highlighted the kind of several acquisitions which they have done in order to build capabilities. And if you look at the last chart on the right-hand side, what they're also doing is that they're also sort of reducing their dependence on top 10 clients. So they have a very focused sort of client mining strategy wherein they want to broad base their revenues so that their dependence is not very high on the top 10 clients. The reason for that is that they don't want to end up in a business environment where it's very cyclical. So if you look at Persistent, clearly the non-top 10 clients exposure has been consistently going up. So clearly, we believe that many of these mid-cap sort of tier 2 IT companies will continue to do well, like they bringing in moats around their attracting significant talent, and more importantly, retaining those talents by ensuring them with aligned incentives. Yeah, so continuing on that particular model, we also sort of highlighted other examples, which is of Birlasoft, which essentially displaced a tier 1 vendor in the large 100 million deal. Again, the case study being very similar compared to Persistent. So Birlasoft has also seen CEO change. So a person from Wipro with work ex of more than 13 years at Wipro had joined in Birlasoft, and since then there has been a significant improvement. Likewise, if you go through our newsletter, We've given case studies on multiple other companies. Obviously, in this webinar, we can't discuss all of them, but there are a few highlights only which we are mentioning here. If you look at on the second chart on the right-hand side, what we're trying to sort of highlight is that across large clients, these mid-cap IT companies have made their presence being felt. So if you look at JP Morgan, FedEx, Wells Fargo, etc., clearly you don't just find large cap IT companies being their vendors, but also a lot of mid-cap IT companies being their vendors. So a lot of these high-profile clients also want bespoke kind of contracts being sorted out. So those offerings are now being won by mid-cap IT companies. So they clearly are gaining share in terms of wallet from their large-cap IT customers as well. This is what we wanted to discuss as far as the reasons why we continue to like the mid-cap tier 2 companies. If we move on to the next slide. Yeah, Tilok, you can take it over.
Yeah, thank you, Bhargav. And I will probably take you guys through what's happening around. Obviously, the most heartiest of the all, the big positive surprise for us was a very strong earnings growth. Very strong economic growth in the Q3, and we obviously reported a very sharp 8% plus growth, which is on obviously a back-to-back perspective, a very strong and hearty number, and importantly, from a festive season, an 8.4% growth was marginally ahead of what most people expected. Importantly to note is the consumption remains a relatively muted growth, despite a growth on nearly 2% on a YY basis. It's or a 3.5% growth, but when you also look at the gross fixed capital formation that continues to sort of do well, but more importantly, it's primarily the government capex which is obviously driving this particular growth, and we have also seen some manufacturing also seen a sharp improvement, almost a double-digit growth. So I believe a lot of capex which government had announced incentives for, also from a public nation capex perspective, usually associated with the strong capex from the government prior to the election, has been also been the on ground effect that we saw. So there is obviously some meaningful divergence in growth rate between consumption and investment so far. Broadly, the contribution to GDP remains sort of similar. We believe fixed capital gross capital formation is a relatively anomaly, given the fact that private capex is yet to revive, and we are obviously not seeing. We are seeing a lot of signs of capex, private capex announcement, but we haven't seen meaningful deployment of capital on the ground for most private component perspective. So undoubtedly, government is the sort of institution who's driving the particular growth. That's broadly on the economic front. Importantly, the most important point to note here is we believe as we progressively move forward, and usually typically between a quarter year, 1 or 2 quarters combined, we also expect some moderation of public capex, primarily between now and June quarter. Only post July you will see massive uptake again happening once there is a certainty of elections coming on the ground. Moving ahead from GDP to what's happening on the system, liquidity obviously remains a key monitorable for both RBI as well as for large investors. We believe, as we have been talking about it, that after nearly 4 years of surplus liquidity, we are seeing a record sort of liquidity deficit. Now we are at almost a 4 lakh crore sort of liquidity deficit. There will be certainly RBI interventions in terms of managing liquidity, and certainly government expenditure and forex will be also being intervened. But so as we progress, as we speak, certainly in liquidity it remains a very challenging sort of scenario. Importantly, in the near, in fact, we have already seen an inverted yield curve where the short-term rates have moved up sharply over the last 45 to 60 days, and the CPCD rates have moved up in tandem as well, which will also reflect in the borrowings for a lot of corporates in the near term. So working capital cost will certainly move up for the market, corporate market as a whole. But our belief is RBI will intervene, particularly through OMO purchases or similar sort of tools that they have. This will probably help them to manage the short-term rates, but in the long term, at 7.25, we are at a very reasonable and comfortable level. And please bear in mind, from beginning June 24, you will also see a significant demand for long-term borrowing, particularly 10-year GSEC, once the MSCI bond inclusion index, investments begins. So moving ahead from what's happening as I spoke in the previous while covering the performance, that there has been some victims of the good companies in NBFC also faced some of the regulatory changes. So RBI has, over the last 3-4 months, particularly around Diwali and since October, have done a series of or slew of measures in order to either curtail growth rates in unsecured lending, or also in some cases you know in some cases also change or monitor the practices that are taken by a lot of companies. So right in front of you, there are obviously these four institutions have got diktat or observation slash update from the RBI from various businesses activities that they're doing, right from either who could be in gold loans or IPO financing or for the deposits, and Paytm Bank, what they did, and also disbursal of loans on e-commerce. So all in all, I believe right from increasing the risk-weighted assets for banks to also tightening the screws wherever there is a policy which has been clearly compromised on from a lot of NBFCs. RBI is taking all the right measures. Notably, in the last 2.5, 3 years, unsecured credit has seen the fastest growing segment in this country. And our sense is when RBI sort of intervenes in each of these segments, or incrementally, further segmentations or the players that we can see of, RBI is certainly not comfortable with these kind of growth rates, given the fact that there is no subsequent, sort of growth in terms of income levels as well. From an average point of view, I'm not talking about businesses or or the income levels for urban centric sort of consumers, because urban centric consumers have seen a very strong growth, whereas rural continues to see a very moderate growth over the last 3, 4, 5 years time frame. So we believe compliance and supervision can further accelerate going forward, and unsecured lending as a space will be closely monitored by RBI. And thankfully, none of our portfolio companies are overtly exposed to these unsecured lending, or we are investors in any of these NBFCs, or our NBFCs are top class by a wide margin, and with minimal asset quality issues, as we see. From moving ahead from regulations to markets again, we are seeing markets now at probably reaching at so until maybe a couple of months ago, we were at 7 to 10% discount to long-term averages. Now we are broadly in line with long-term averages from a Nifty perspective. Also, our price to book is obviously a meaningful premium compared to long-term averages. But I think price to book is also a function of what ROEs are we going to end the year at. We will probably end the year in FY24 to around 16% ROE, which we saw the last was in FY12, 15.4. So we will obviously end the year with a decade high ROE, and price to book should always be looked in conjunction to to ROEs of a particular stock sector or a particular index. So we believe valuation gap have narrowed. We are obviously at a zone where we will see more capital falling earnings growth and judicious, approach in terms of what selection will be more important going forward. And our sense is market valuations, will remain elevated and will only come off in case of extreme disappointment in earnings. Obviously, the near-term markets will remain volatile based on the most important event that the market is having an eye on, which is the upcoming general election. With that, I would probably open the floor for question and answer session.